Rarely has the US Federal Reserve been as divided as it is ahead of next week's meeting. At the press conference following the October meeting, Fed Chair Powell stated that there were strongly differing views on how to proceed in December. The published minutes of the meeting confirmed this assessment. The Fed's decision is so difficult because the Fed finds itself in a dilemma. The slowdown in the labor market is the main reason in favor of rate cuts. The fact that inflation has long been above the 2% target is an argument in favor of higher rates. We expect the Fed to cut rates by 25 basis points next week. Ultimately, the Fed is likely to take greater emphasis on the risks in the labor market, especially as it should slow down wage growth and thus inflation in the medium term. Another argument in favor of a rate cut is that the markets are pricing it in with a probability of around 90% and that the Fed has not yet signaled that this is a misjudgment. Above all, there is political pressure on the Fed to ease monetary policy further. Looking ahead to next year, we expect only one more rate cut before Powell's term ends in May. Once Powell's successor takes office, the pace of rate cuts should accelerate. President Trump is likely to nominate a successor loyal to him. The favorite is Kevin Hassett, who's responsible for economic policy at the White House. At Trump's request, Hassett is likely to cut policy rates to 2.5%, a level that is too low in view of the inflation risks. Ultimately, Trump's personal policy will significantly reduce the Fed's independence, similar to what happened in the 1970s. This is an important argument for why we expect US bond yields to rise in the second half of next year. This also applies to German government bonds, which still show a certain correlation with US government bonds.